Hello, welcome to the Money Café. I'm Stephen Mayne, contributor, intelligent investor, founder of Crikey and shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
Now, James, the Lionel Messi of Australian business journalism, Mr. Kohler, is having a well-earned break, so I consider myself very lucky. I get to talk to the Kylian Mbappe of Australian business journalism instead. Have you been taking in the World Cup, and what's your hot take?
Oh, well, look, I guess I have. I think it's been... Wow, it's had a bit of everything, hasn't it? It's gone on for a long time, but they extended the number of countries involved from 32 to 48. I must admit, I thought at the start of the tournament, it's going to drag a bit, but look, it's been great fun, I reckon. Terrific tournament for Australia in terms of the time zones have just worked beautifully. We've been able to watch a lot of it at pretty reasonable times and. It's been nice to come into the office and have it sort of playing in the background some mornings. So, yeah. And I think from my limited knowledge of soccer, the best team won.
Correct.
Spain was the sort of, seemed to be the purest footballing nation throughout the whole thing. And so I think that the right result was earned in the end. And
correct. I thought they just dominated both Spain, France, and Argentina, and everyone was saying France was going to win. So, but it's just demanded global attention like no other sporting event. I mean, I was amazed this morning that the boss of Coke rang the bell at the New York Stock Exchange this morning, Monday morning, and why? To celebrate their sponsorship of the World Cup. I mean, since when does a sponsor of an event? You've normally got to have an IPO to get to ring the bell at the stock exchange. So
I think the bell ringing at the New York Stock Exchange has become a little bit less special than it once was, perhaps. From all sorts of people get in there and ring it. So anyway,
yes, no, I completely agree. Now, Russia was banned, and China didn't even make the top 48 teams to get to the World Cup. But boy, they're rocking the boat in the AI space, aren't they? You had an interesting column on Kimi and the AI wars.
Yeah, look, this has come out of nowhere. I mean, you'll remember about 18 months ago we had this, what became known as the DeepSeek moment, when this Chinese AI lab called DeepSeek released a large language model that appeared to come from nowhere to compete with ChatGPT and Claude, which is made by Anthropic. Basically, the same things happened again. An AI lab in China called Moonshot AI has released a model called Kimi K3, which only trails the very best bleeding edge frontier models from OpenAI and ChatGPT. OpenAI and Anthropic. The way to think of it is that Anthropic and OpenAI thought they had about a 12-month lead on the Chinese labs. Now,
no, you don't.
Now it looks like that lead is 3 or 4 months at best.
Yeah.
So what does that mean? I think everyone's trying to figure that out at the minute. Obviously, it's not great for OpenAI and Anthropic, who are charging premium prices for what everyone thought were premium AI models, and now that is going to have to be reconsidered. But of course, there's sort of the strategic imperative between China and the US. Could the US government ban Chinese models, which have become, they've got a 30% market share in the US at the moment because they're cheaper. Is there a political element to all this? That's yet to be played out. And of course, the billions in data centers investment just keeps rolling on. Is that going to earn the returns it needs to if the profit pool from these AI models is reduced? Because that's the danger here, Stephen. Like, these AI models basically become a commodity, and it's very hard to make money from commodities.
And I was interested to see that the SpaceX shares are down to 120. So I'm very happy with my decision now. They floated at 135. I applied for 10, got 4, sold 3 at 150. Yeah. So I sold 3 at 15 above, and now my remaining 1 is 15 below the float price. And the thing's down $1 trillion from top to bottom in market cap, and poor old Elon Musk is dealing with the issue of being the world's first former trillionaire. How would you cope with that?
Yeah, exactly.
And this is partly, I mean, yes, it's burning cash, but it's partly an AI bubble popping
Totally.
element as well, isn't it? Because that's where they're blowing most of their cash, is trying to keep up with the Joneses in the AI space, and they're like the ultimate laggard in that space.
That's right. I mean, XAI, which is part of SpaceX, it's way behind Anthropic and OpenAI. But sure, I mean, you add these two things together: SpaceX sort of tumbling back to Earth and the release of Kimi K3. That doesn't make it easy for OpenAI and Anthropic to float anytime soon. I wouldn't have thought. Certainly not at the $1 trillion valuations they were hoping for. So that sort of casts a bit of a pall over all this AI trade as well. I mean, just sort of think about OpenAI for a second. They've committed to spend over the next, between now and 2030, about $830 billion US. So if you go across Microsoft, Amazon, Oracle, Alphabet, they've got about $730 billion of OpenAI spending commitments on their books. Now, what if it evaporates?
It doesn't stack up.
No, I don't think it stacks up. But I think Ed Zitron, who is a really fascinating sort of AI skeptic. He's been
Chief Bear, isn't he, Ed? He's
He
the
is.
go-to man if you want to hear a contrarian. This is a bubble sort of a perspective, isn't he?
Yeah, but look, he writes really well and has lots of evidence, does lots of reporting. He's very impressive. His argument is OpenAI is the Lehman Brothers. It's the linchpin that if that linchpin goes, then this bubble goes. So, yeah.
Well, I think it's between SpaceX, OpenAI, and Anthropic, they're all bleeding cash. So something's got to give. There's going to have to be some form of rationalization.
Yeah.
They can't all keep doing what they're doing. The existing incumbent big tech, they've got the balance sheet strength, the cash flow. I mean, interesting that Apple and Nvidia are both now equal top market cap company in the world at 4.9 trillion. So Apple, being the big tech company that's spending the least, that hasn't gone all in with massive spending, is being rewarded at the moment for their model of sit back and wait and then clip the ticket, which is how they play it. But I can't see how those three. I mean, I agree. SpaceX were lucky to get the $85 billion away, but you'd think OpenAI. I mean, they have raised a lot in the private market, so they but I don't know if they're going to be able to get mega 85 billion type IPOs away. And I think also with SpaceX, there'll be, those 3 million ComSec customers, all with the ASIC green light, getting emails from ComSec saying, get into SpaceX. I mean, if it keeps falling, the pressure will come on there about why'd you do that, ASIC and ComSec.
Yeah, I think that is an interesting point. The only thing I keep thinking about, Stephen, is we've seen moments like this before. I mentioned DeepSeek. Like, that passed fairly quickly. The AI trade got back on track. People buy the dips. It's just become such a winning strategy. So I don't think we can rule that out. And look, the S&P 500, it's, 2% off its all-time high? We're not talking Great Depression here. So, it's tense. But, you've got that. You've got Iran sort of turning into a forever war, isn't it, a little bit?
Oil back to 91, ninth straight day of strikes. I mean, the hope was, World Cup, let's all get this sorted out, but the World Cup's over and the Iran war keeps going. So the Houthis are getting involved, threatening the Saudis, looking at another choke point. And, I'll be interested to see whether the federal government puts the extra 16 cents back on August 3, because at 91, it's going up. And look, it's how do you predict it though?
Yeah, well, yeah, exactly. I mean, but what the sort of intersection that interests me, Stephen, is we've got a lot of upset now and concern about where housing's going. If this war drags on, the inflationary pressures from energy are going to just continue to build. Doesn't leave the RBA with a lot of wriggle room. I mean, if there's one more rate hike and then maybe a second, that's going to be nasty for the housing sector. I mean, clearly we're getting this sense at the moment no one wants to catch a falling knife. Everyone's waiting to see where prices settle. Why would I buy now if in 6 months the prices are going to be lower? Sentiment in housing is pretty ugly at the minute. So Yeah, it's sort of a bit of there's a few interconnected things to watch at the moment.
Absolutely. Now, James, we were a tag team last year at the Macquarie AGM. It's on Thursday in Sydney. I'm flying up for it. But last year I asked the question whether Glenn Stevens was asleep at the wheel because he'd missed the fact that there'd been a remuneration strike, that the shareholders were unhappy and they got their first ever remuneration strike. And quote, Glenn Stevens said, I mightn't have been very effective, but I wasn't asleep at the wheel. And you wrote a column calling this one of the all-time most memorable AGM lines.
That's right. Yes. I hope you can set it up for me again on Thursday, Stephen.
Well, to celebrate this, James, I've actually just appointed last night Anthony McDonald as my proxy. So if you're, I've only got 2 shares, you see, so I figured may as well 2 shares, 2 speakers. I thought, so if Anthony happens to be walking past, he could just pop in and have a chat, and I'll go in as a non-voting but speaking shareholder, and he goes in as my proxy, and we can have a chat because it's going to go for 3 hours as usual. They've got a climate change resolution, and the climate resolution got 35% last year, which was a bit of a shock to them as well, to have the shareholders literally revolting on climate. So the market forces people have come back again with a similar hostile shareholder resolution, plus they're coming off the strike, first ever strike, but all the proxy advisors have recommended in favour. So I think you're going to find that they're going to get comfortable support for all 8 resolutions on Thursday.
What's your sense, though, Stephen? I mean, the proxy guys seem pretty happy that the Macquarie board has heard the message on pay and pay disclosure, particularly. Is
That's it. It's the usual system of get a strike, get scared, fix it, don't get a strike, don't get a double strike or a second strike. So they've moved on the issue of holding back bonuses due to regulatory infractions. That was the issue last year. Was your ASIC's pinging you? There's all this stuff going on with regulations, and you're just giving bonuses, as if it hasn't happened. So they have moved on that, and that's why they won't cop any big protests. But a couple of interesting things. Do you know that Shamara, the CEO, has never sold a share, and her 1.47 million shares at the moment are worth $376 million because the stock's at 256, which is the value in the company at 99 billion. So I'm quite proud of giving them their nickname, the Millionaires Factory, and it's never been more appropriate because, look, Shamara's got that huge shareholding herself, but the bank itself is its largest shareholder. So it owns Macquarie owns 7.27% of the company, which is worth $7 billion. So that is actually just the staff share scheme. And this is the one I really find amazing. Each year with their staff share scheme, when they're coming up with the bonuses, they have to organise to get hold of the stock, to restrict it, to give it to the staff. So this year, that figure, they had to buy $734 million worth of their own shares to satisfy the bonus scheme. And they bought 681 million of those shares off their own staff who already had previous bonus shares. So in an off-market transaction. So that's how the Millionaires Factory works. It's just long-term share grant bonuses. And when the stock's at 256, remember it floated at 6, it is literally a Millionaires Factory like nothing else Australia's ever seen. And so it should be happy days on Thursday because it's never been higher or stronger.
No, that's right. It's amazing what a record share price does to alleviate any angst.
That's right. So in terms of when this happens, James, and you go to an AGM, you think, what can I ask when everything's going so well? So one question will be to Glenn Stevens, the chair. He's been there 9 years on the board. He's up for election next year. Glenn, are you going to run again? So that's always a good question. And then the other one is the whole audit situation. So the last 4 AGMs, I've been banging on about PwC getting $2 billion over 30 years. You've never done a tender. Why is PwC the auditor? They finally, out of embarrassment, ran a tender, gave PwC the punt, put in KPMG, and now this is a whole scandal of itself about how KPMG got the job, and KPMG former partner Michelle Hinchcliffe is the chair of the audit committee, and was she involved? And so that's going to be a hot topic, I suspect, on Thursday.
I agree.
In Sydney.
Yeah, and it's all your fault by the sound.
Well, it's a good question. have you? When did you last do an audit tender, and when are you next going to do an audit tender? And when the answer is never and never, it's not sustainable. And that's where Macquarie was at. They'd had PwC for literally 40 plus years.
Yeah.
And including on all their listed funds, it wasn't just the headstock, it was everything. And so it was very lucrative for PwC. PwC copped a scandal, out they go. KPMG gets the job. Now KPMG's in the middle of a scandal, partly involving the Macquarie tender. So, there you go.
Yeah, what a mess.
Now, you did an interesting column this week, Man Overboard, you called it. The too many men with too many jobs in the director club.
Yeah, so the idea here is a proxy firm called Ownership Matters does a bit of a score. They score directors based on their workload. So you get 2 points for being an ASX chair, 1 point for being a director, and there's a sort of sliding scale from there. And the argument that Ownership Matters makes, and I think it's a good one, is that, can popular directors are popular because they're experienced and sought after. That's okay. But there is a point where you can become what's called overboarded. You can have too many board roles, and it's not a problem until it is, until the one of the companies you're involved in, or heaven forbid, 2 or 3 of them have, a takeover on, or some sort of scandal, or some sort of issue, a CEO transition. And then the question is, are you stretched too thin? And does that become a risk for the companies you're involved in? So it's a good question. Gary Weiss is adjudged by Ownership Matters to be the most overboarded director in Australia. I think he's got 4 championships.
Oh, look, Gary Weiss is ridiculous. I'll tell you a funny Gary Weiss story. So I went to the Thorney Opportunities AGM last year, and so Gary Weiss is chair of 4 companies and on 3 other boards. And my question, it went through a range of protest votes that he'd suffered because of his overboarding. So, 18% when you ran for the Myer board, 13% when you ran for the Premier board, 27% when you ran for the Cromwell board. Aren't you taking the message, Gary, that the shareholders are protesting? Mm-hmm. You know what the answer was? He's not here. He's too busy, James. He's too busy to turn up to the Thorney Opportunities AGM. And the real joke with Gary is, he's 73. He's paid $750,000 a year. He's actually the CEO of Ariadne, which is a Brisbane-based company. Now, look, it's only a property sort of company, but he's paid as a CEO of one company, and then he's off as the chair of 4 others and on 3 other boards. He's deputy chair of and lead independent director of Myer. And their shares are in the toilet at 26 cents. And with Myer, it's all hands on deck. And the guy who's literally the lead independent director and deputy chair on a 4-person board, he can't possibly do that job properly when he's got all these. He's a full-time CEO and he's got 7 other gigs. He's an NRL commissioner, for goodness sake. He's out there negotiating $5 billion broadcast deals with your employer.
Yes.
Mine.
Yes. Yeah.
How does he fit that one in? He does it, 10 o'clock on a Sunday morning? So it's an interesting issue, and he is at the sharp end of that, I'll tell you.
Yeah, yeah. So look, it's interesting. And look, well, I think it's always a conversation in the lead up to AGMs, and I'm sure you'll be asking plenty of pointed questions when the season rolls around.
Indeed, James. Now, we've got a lot of good questions including some female questions this week, which is great. But before we get to them, let's have a quick word from our sponsor.
Picking investments, rebalancing, and keeping on top of markets can feel like a lot. InvestSmart makes it simpler with professionally managed ETF portfolios. Open and fund a new InvestSmart portfolio in July and receive a $100 bonus contribution. Visit investsmart.com.au to learn more. Remember, past performance isn't a promise of future success. Terms and conditions apply.
Now, before we start, as Alan intones every week, this is just general advice, and if you want specific advice, talk to a real expert. Now, we'll start with Kobe. Kobe says, as a mother of 2 young sons, I'm concerned about the new capital gains tax changes. If the goal is to improve housing affordability, why are young Australians who invest responsibly in shares or ETFs to save for their first home being caught up in these reforms? A young person earning a low income could end up paying a minimum 30% tax on their investment gains despite not owning property or contributing to rising house prices. Aren't we making it harder for the next generation to save for a home by penalising sensible long-term investing? Now, we've had a number of questions about the 30% thing. It is probably at the very, very sharpest edge of the changes, isn't it?
I think so, yeah. I'm It's fascinating that the government's sticking with this. Like, you can understand what they're trying to do in the property market. I think there's some unintended consequences with the 30% tax on non-property assets. I'm surprised there hasn't been a back down, but here we are. And I think Kobe's right. I'm not entirely sure that this tax is where we want to go, is it, Stephen?
Oh, look, I agree. But look, it's been legislated. So they've done it. I mean, and when you twin it with the trust situation, so the absolute sharp end of this is long-term unrealised gains within a trust. And a lot of people have got their retirement structures around that. So they're copying it. And then, of course, you've got the young people saying, all the opportunities that my parents had. I'm just trying to get a few capital gains on my ETFs just to try and get ahead, and bang, the government's taken me 30%.
Yeah.
Even though I'm only earning 20 grand at uni, something like that. I mean, to exclude the tax-free threshold for someone who has no assets except if, they got lucky on crypto or some flying rare earth stock or some big tech stock, I just can't see how you can justify removing it from the regular income tax arrangements and saying that capital income is different and taxed higher than labour income. I mean, it's all income. It should be the same, I would have thought.
Yeah, no, good call. Lee from Brisbane says, love the podcast. Here's my question. The federal government seems determined to make Australia a home for the next wave of AI data centres with faster approvals and promises that operators will cover their own power and grid costs. But even if they pay their own way, what do we actually get? Most of the gear is imported. They employ relatively few people once built, and much of the profit's likely to end up offshore. If the economics of generative AI never catch up with the spending, are we giving up land, water, and power for a construction boom that leaves Australia with very little once it's over?
Well, interesting. In New York, for instance, the governor has just put, I think, a 1-year moratorium on data centres, and they've already got 130 in the state of New York. And the argument being that little councils aren't in a position to negotiate with, Oracle and big tech. And so we're going to hold it for a year. So this has sort of, fracking comparisons, where central governments or states or federal sort of lean in and go, oh, no fracking. So, look, there is a backlash. I'm not so sure that it deserves a sort of a national approach, which we seem to be toying with. I mean, you can't leave it to your local council, but the state governments in Australia already dominate the planning on major projects. So
I think Lee has articulated this question really well. Like what, and actually Anthony Albanese sort of asked this question last week in his big AI speech. He said, we don't want this to be a construction boom and that's it. We need to lean into this AI boom in a sort of more sustained and sustainable way. And I think Albanese's right and Lee's right. We do need to find ways to sort of get the most out of this boom, not just not just make it a construction boom, because it's while it's the biggest investment boom since the mining boom, it's very different. And Lee's hit upon that. There's a lot fewer jobs involved. A lot of the equipment's from overseas, and a lot of the profits are going to flow overseas. So it is going to be really tricky. But I think you sort of look at the Australian economy and you do think, can we afford not to be part of this AI boom? Like, we don't exactly have a lot of other strengths to rely on at the moment.
No, well, it's about fast and reliable compute at the end of the day. Yeah. I mean, and we can't sit back and say, we don't want fast and reliable compute. We don't want to have the capacity to tap into the best and greatest AI models out there. I mean, I just don't see how we can step apart from this sort of global trend. I mean, you've got to have good rules. I mean, down here in Melbourne, I think there's $1 billion one going into Footscray at the moment, and close to $2 billion near Tullamarine, near the airport, that next DC is doing. So, at some level, the cat's already out of the bag in terms of there already is a gold rush in terms of approvals that have been given and construction that's underway. But there's a lot more in the pipeline as well. Absolutely. A lot of that $800 billion that big tech's talking spending is for the pipeline, and not all of them have been approved, and there is a growing backlash. But I don't see how we can necessarily totally step away.
Yeah, so I think it's good Albanese sort of made this a priority. We need to figure out the right path through it. So it's going to
I agree. Now, Simon says that with all the calls to regulate the big four accounting firms, and with the scandals at PwC and KPMG, what if you go back a generation and recall that there was actually a big five accounting firms, from Arthur Andersen being the fifth pillar. Arthur Andersen dissolved following their cover-up and shredding of documents in their audits of Enron and WorldCom. I remember those days, which were uncovered after the collapse of those entities. These audit cover-ups were because Anderson's advice arms were being paid millions each week, so the audit practice didn't want to disrupt the relationship with the valued clients. Sounds very similar. This resulted in the Sarbanes-Oxley Act being rushed into the US. Does Australia need a similar law to Sarbanes-Oxley to protect investors from these predatory consulting firms? Boy, Simon, you're not holding back there, mate.
Do we need a separation of audit and consulting? Not sure we need to go that far. We need to do something, though. I mean, the government's had what irritates me here is the government's had, after the PwC scandal, options to tighten the regulations around these businesses. They've had them on the books or under consideration for like 3 years, and nothing has happened. It's very strange, given you've got Labor Senator Deb O'Neill has done such a great job, really campaigning or crusading on this, and she's just got no support from within the government, just none. They don't even seem that interested in doing anything now, even with the KPMG scheme blowing up. So there are things you can do. I mean, I know you're big on sort of audit tender periods, mandatory.
So you must, this is the UK rules, you must do a tender every 10 years and you must rotate every 20 years. But on top of that, I was actually just had a thought bubble right now. What about ASIC appointing auditors? Take it away from the boards. So if ASIC appoints the auditors, then the measurement becomes how tough a job are you doing holding the board to account, how rigorous are you, and are you managing your conflicts, as opposed to a board saying, oh, well, we've got a pretty cosy run with this auditor, let's keep them here for 3 decades.
What do? You do it like a barrister system, next cab off the rank type thing?
Oh, well, but I just think it'd be you'd have this mandatory rotation thing, but you actually have the regulator, ASIC, more involved in the appointment. So it's more saying, well, the auditor is actually our cop on the beat. So if we're the regulator, we're gonna get more involved in audit selection, audit assessment. So literally just don't leave it to the boards and shareholders, and get the corporate plod more involved in the system. And then I think some sort of audit regulatory body, maybe. I think Alan's mentioned that before as might be a solution, but. Yeah. I don't know that the full-on Sarbanes-Oxley and the full-on prohibition is a realistic solution.
Yeah, but please, Labor, do something.
Yes.
Don't just keep sitting on your hands.
True.
Kayla says, long-time listener, thanks for your helpful podcast. I'm fairly new to investing. I'm putting money away for private high schools and have spent a few years building a modest portfolio of Vanguard ETFs. My question is about diversity. With the MSCI ETF and others, such as the Ethically Conscious International Shares ETF, growing well, must I diversify with an Australian exclusive ETF? They've been growing more slowly and appear to be filled with banks and other companies low on the innovation side. That's a good question, isn't it, Stephen? I would, general advice only.
Yes, that's right.
And I really have to underline that and highlight it. But I think this is Kayla's quandary here is one that a lot of Australian investors will need to confront in the next few years, because think about where we are. The RBA has to slow down the Australian economy, has to. Michelle Bullock's been very clear on that. And so profit growth in Australia is going to be weaker, particularly in domestically focused businesses like the big banks, as Kayla says. So is this the time... with a slowing Australian economy, is this the time that, if you're not already holding Australian shares, is there really much argument to hold Australian shares over a diversified bucket of international shares? It is
the big question, isn't it? Like we've got $4.5 trillion of super, and how much our market's not big enough for it. So it's all a question of offshore. how much. I remember when the Future Fund got set up, that was one of the big debates, is the Future Fund going to be a patriotic, nation-building, sovereign fund, or is it going to take a diversified global point of view? And they went for the latter. So the Future Fund has a relatively tiny allocation to Australian shares, and has performed very well, taking that sort of private equity, global shares, alternatives approach. And then that's the question that Kayla's asking is, as a retail punter, how do I get on this international game? Because the international scoreboard has outperformed, and that's primarily just been big tech. The US is 70% of world stock values at the moment still, which is an amazing stat.
Kayla's already holding the international ETFs. She's saying, do I need to diversify into Australia? I guess what I'm saying is, geez, it's hard to make the argument right at the minute, Kayla.
Yeah. Well, it's like, when do you jump off? You think a bubble's coming in and a bubble's going to pop. When do you jump off? But the history is littered with, I think this is the top, and then it goes on for another 2 years or whatever. That was exactly the story with big tech into the GFC, the tech wreck and GFC. That was the story, is that the last 2 years kept on going when a lot of people were saying this is ridiculous.
Yeah. If you're holding the indexes, though, MSCI World Index, S&P 500, they do offer you diversification within those indexes. So I'm not sure, that diversifying into Australia just because you feel you need to have some Australian shares is, and that's what a diversified quote unquote portfolio looks like. I don't think that's the reason. I think you want to be confident that the Australian market's got something to offer. That's the question you should be asking.
Yeah, true. Now, Julia says, thanks for the insight and information. I appreciate your encouragement for women and girls to ask questions and engage in investing. London Stock Exchange's Group's 7th Investing in the Green Economy report indicates that by market cap, the green economy has now surpassed healthcare to become the world's 3rd largest industry. What are your thoughts on the green economy as an investment theme in Australia? And why do we hear relatively little discussion about the broader investment opportunities in green products and services? Australia has recognised strengths in areas such as water innovation, nature capital, and environmental services, plus great potential in the circular economy to improve productivity. Finally, I'd be interested to hear your views on green bonds, their successes, shortcomings, and whether they've lived up to expectations as an investment vehicle. The green economy, James, is it a real thing, or is it just a marketing thing? Is that something is branded as green?
I think there's two things going on here. One is it can be a bit of a marketing label used by investment houses to push different products. So I think that's part of it. But one of the reasons you don't hear so much about it, I think there's two. One is that energy security has become bigger than the energy, a bigger issue than the energy transition in the last few years with war in Ukraine and now in Iran. But the other thing is a lot of stuff that we might have called the green economy 10 years ago is actually just the economy now. It's a pretty... Rooftop solar is a pretty accepted part of Australia's energy mix. We don't really need to call it out. Everyone's got solar panels on their roofs, or a lot of people. So, it's just part of the way that the national electricity market and the national energy, industry has changed. So I think that's part of it. Have green bonds lived up to their hype? It's a pretty small corner of the market. I think from what I understand, they've done fine.
Yeah, I mean the federal government, the Australian Office of Financial Management, their website, they offer green bonds.
Yeah,
and they say buy our green bonds, and we'll use it for public, national, green projects. Now they're just going to perform as well as any other of the $1 trillion of federal government bonds. They're not going to trade at a discount or a premium. And you can say, well, this particular bond I'm buying, that I'm lending the government money, they're going to allocate that, they're going to hypothecate that money through to this particular latest $20 billion snowy hydro blowout, for instance. But at the end of the day, it's all just the overall government borrowing scheme, but maybe you feel better. And unless there's actually a preferential tax or a capital adequacy different in green bonds, it really is mainly just marketing. And I personally think the best way to look at this is to not go the positive, but to actually go the negative. And when you invest, make sure you're not investing in tobacco, coal, armaments, or whatever it is that you particularly want to avoid.
Yeah.
That's the way. So that's where that picks up the ethical investing side of things, which is tied up in that broader green economy thing. But look, it's a huge part of the economy. I didn't realise it was deemed to be bigger than healthcare now. It is certainly and we don't have enough renewable energy stocks on our ASX. I think we are a bit thin.
We are
in the green economy space in terms of public companies listed here, because it is a bit dominated by foreign companies and private operators and the like.
Ironically, Stephen, the government could get a bit of bang for its buck with this AI strategy. It's talking about basically making data center operators bring renewable energy to the grid and then organise grid connections. We could, ironically, the AI boom could be the reason that we finally get our energy transition really stoked up. So there could be a double win there, and I think that's something that the government's trying to engineer. I mean, let's see how it goes.
And we actually had a question later. We probably won't get to it, but someone saying on data centres that Tasmania should be the home of Australia's data centre industry, as long as you've got the fibre under the Bass Strait working, because unlike with transmission lines, with fibre there isn't the latency of long drags, so you can drag fibre a long way. And of course Tassie's got surplus green energy, whether it's hydro, whether it's wind, so Tasmania as a clean green data centre hub, with pulling those cables under Bass Strait and keeping the compute firing in Melbourne and beyond.
There you go. Well, Cam's got an idea for us, Stephen. Why don't the government lower the tax on overtime to encourage productivity? We have awards that state your base wage now, so why not lock that in for the current income tax thresholds and have a much lower tax rate on overtime hours above the threshold? Interesting idea, Stephen, but practically difficult.
Can you imagine the complexity of that? So Cam's saying, I sometimes don't take an overtime shift because who wants to pay 47% to the government? So I actually think the solution to his problem is just lower overall taxes on middle Australia. And it's ridiculous that the top 47% rate starts at 190K or whatever it is. It shouldn't start until at least $500,000. But can you imagine the complexity of calculating your tax, where what's an overtime hour and what's a different hour? So it would just get gamed, I think. Cam, it would be very complicated to get gamed. But I'm all for lowering income taxes and maybe putting up the GST death duties and higher resources taxes to fund it. But
well, and I wrote a piece last week about sort of productivity and why we aren't outraged about that. And that is, Shane Oliver, veteran economist at AMP, that's his top thing. We broaden the GST, we bring income taxes down, and we get rid of other sort of state-based taxes that lean on productivity. But we have these ideas, they just get nowhere.
Yeah, no, exactly. Lots of ideas. But keep the ideas coming. We love to get them. Yeah. Now, Lincoln wants us to have a fight between the generations, I think, James. He says, no doubt the cost of living and cost of property has gone up drastically, but the current young generation just have too much need it right now mentality. I've got the same old phone, same old shoes, same old car. I've rent shared, BYO lunch to work, etc. Too many young people I know rent a 2-bedroom unit by themselves, always have the latest phone and clothing, a fancy brand new car on loan, buying coffee and lunch every day. It is actually just really tough out there. Is it? Or is this generation just doing it wrong? Now, Lincoln, you forgot to mention all the international travel and holidays as well. But Lincoln, you can't just stereotype, whether it's race, gender, or even generation. There's some young people who are massively good savers who are doing what you're doing, Lincoln. And there's others who appear to be. I think maybe we notice it more because of social media. You see Instagram, someone's on holiday in Japan, and the oldies look at that and go, oh, they're always just on holidays. What do you think, James? Are the youngsters just living it up too much or what?
I think Lincoln's forgetting the sort of chicken and the egg thing here. If it looks impossible for you to get into the housing market any time in the next 30 years, are you not entitled to spend a bit more of your income on rent and, stuff that gives you a bit of pleasure now? I think this idea that people of a certain generation have that, you can sort of live frugally, work hard, and a house will miraculously be within your reach. The numbers just don't add up. It's just not how it works anymore.
Yeah. It is interesting, isn't it, though, with the bank of mum and dad equation, this whole sort of early estate management to help the kids into property, and then you get this debate about, but you haven't done it hard enough, son. If you hadn't done this round the world trip, you might have saved for a deposit. So that discussion, that negotiation, that little subtle debate is happening in families up and down the breadth of the country. But I don't think there's an argument for starving the young. I mean, the HECS debts and the cost of housing, it has never been tougher to get ahead without the bank of mum and dad. That's just a fact.
And no doubt, like lots of people make, as you said, lots of sacrifices throughout the period. But people of Lincoln's, but people in I'm not sure if Lincoln's old or young or what they are, but older generations did have the sort of tailwinds of 40 years of generally falling interest rates. Yes, I know they got up to 18%. You don't have to tell me again. But generally falling interest rates, generally rising asset prices, generally more largesse from the government, including free university for a long period. Those were big tailwinds that are just not available to younger people today. And the result is very high asset prices that are going to be a huge issue for a long time to come.
Yes. Now I think we've got time for one more. Let's finish with another female question which is targeted at you, James.
Yes,
Jackie of Dulwich Hill says, this is for James and his apparent ignorance of smoking rates and the facts indicated in his episode on July 8. I've waited until this latest AIHW data was released to unleash my concern for his overconfidence in excise-related and health promotion strategies of the federal government, specifically the Department of Health. Smoking rates have continued to trend down. We're almost on the floor for a whole-of-country population. It's gone down faster than previous prevention plans had predicted, and vaping rates have stabilised. Now, I won't read the whole thing, but Jackie's basically saying stop focusing on the headlines and the organised crime stuff and don't advocate for lower taxes because the policy is working and the issue is not the overall volume because the overall volume continues to fall. So in other words, great public policy outcome. The only concern is the share of that volume which is illegal. And I think everyone agrees that 50% taken by the bikie gangs is a ridiculous public policy fail. So look, maybe we can agree that I think Jackie is saying she agrees that the states need to get into the organised crime and the feds, but she's basically resisting the idea that you'd cut the tax to fix the problem.
Look, Jackie's right. The latest data, which was out sort of late last Friday, it's certainly encouraging. I mean, the daily smoking among Australians aged 14 and over, it's down from 19.5% in 2001 down to 5.6%. That is a great public health result. Is it all because of the tax? I mean, Jackie in her question refers to some academic research. Certainly the tax is important, but so is things like plain packaging, banning tobacco advertising, creating smoke-free public places, graphic health warnings, mass media campaigns, supporting people to quit. I mean, Jackie refers to Professor Becky Freeman, and she's got a list. Yes, certainly tobacco taxes are on there, but it's not the only item on there. I'd also just refer to a little note of concern expressed by the Australian Council on Smoking and Health about what the data says. So what the data says is it's the question they ask is do you smoke daily? Which is a good thing to ask, but what the Australian Council of Smoking and Health is concerned about is that they've heard from a lot of doctors that some patients who have previously smoked, 1 to 5 cigarettes a day are now smoking 10 to 15 or an entire pack because they're so cheap. Because illicit tobacco is everywhere and its market share is something like 50%. Yeah. So, Jackie, I take your point. We have done a great job on getting smoking rates down, but I would be very concerned, like the Council of Smoking and Health are, that the way the tax regime has allowed illicit smoking and illicit cigarette sales to explode raises some concerns about whether we can keep those smoking rates down.
I agree. Now, look at James, there's a failed gambling reform campaign. And I used to always say, treat gambling like tobacco. How can the same country have the world's lowest smoking rate and the world's highest gambling rate? Australians are losing, $30 billion a year. And it's the fact that tobacco is still it's not accepted in polite society. But with the gambling, even the Labor Party runs 4 poker machine venues. The Labor clubs in, Sydney and Canberra. Would the Labor Party run tobacco shops? What would the community say if the Labor Party was running a chain of tobacco shops at the same time as they're trying to regulate tobacco? That is literally what happens in the gambling space. They run poker machine venues, and at the 3-day ALP National Conference in Adelaide this week, there won't even be a resolution saying we should divest from the gambling industry. So sorry, I've just had to finish with a big rant there. But
No, fair enough.
it is interesting how Australia treats the different sin industries, isn't it?
Yeah, totally.
Tobacco versus gambling.
It's a good point, Jackie, and I've got to say, Jackie's on the winning team here because the government's made it very clear that it's not going to touch these excise levels. So
Yes.
all my arguments don't really count.
I agree they should cut them by 80%. Temporarily, only let the big boys like Coles and Woolies and IGA sell tobacco for 3 years. So just totally shut down every single tobacco shop and then put the tax back on. But they just need to do something. You cannot have, in a sophisticated democracy, you cannot have bikie gangs doing literally many billions and billions, costing the government literally $7 billion in excise now because they've got 50% share. It's just ridiculous.
Yeah.
And on that note, James, we better wrap up. But thanks for listening to today's episode of the Money Café. I'll be back next week with the Kylian Mbappe of Australian journalism, Mr. James Thomson. So Alan continuing his well-earned Lionel Messi break. So send in a question and James and I will answer it together by emailing the Money Café at intelligentinvestor.com.au. Until then, I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
Talk to you soon.